Hi, good afternoon. I'm Kartik Malhotra. Well, markets today are trading at an all-time high, and if you stayed invested during the pandemic, I'm sure you would be a happy investor today. But even if you did not, is it too late to start? And if you are about to start your investment journey, then should mutual funds be the only tool you should consider in your investment arsenal, or a pinch of small case, a little sprinkle of gold, and dabbling into cryptocurrencies should also perhaps be considered? Well, I don't have all the answers, and that's why I've got with me Feroze Azeez joining in from Mumbai. Hi, Feroze. Thank you so much for sparing time and being with us here on Money Night. First up, what's on your radar? What should one be looking at in investing right now when markets are trading at their all-time highs? Should they look at thematic funds or should they look for a more diversified portfolio?
Karthik, I think thematic funds and sectoral funds have been a no-no from mathematics perspective, is why we at Anand Rathi have not recommended them for the last few years, maybe a decade. Because in a thematic fund, what happens is entry and exit both become very critical. If you bought a banking sector fund at the wrong time and didn't exit it, or bought it at the right time but didn't exit it, then you will come back to a return of a diversified portfolio. So point one, thematic schemes and sectoral funds have a very large importance of the exit timing as well. And most people end up missing that. So over long periods of time, they converge their performance with diversified funds, but take 40-50% extra risk for no special gain unless you can trade in them and exit them. And that's capability which most retail investors don't possess. With mutual fund is a retail platform. Second point, what should you be investing? I think diversified portfolios, I think the top 250 companies, which is what mutual funds cover in their assets, which is top 100 are called large cap and the subsequent 150 are called mid cap. They're very well diversified. Sectors which do very well automatically get a larger weightage because Nifty is a market cap index and so are the other indices. So point one I'm making is if banking does well, be rest assured that it will get a larger weightage subsequently 6 months from now. So that's why I think diversification on the market cap basis automatically brings in a bias of a growth philosophy in them.
Right. Feroze, last time when we had spoken, you had mentioned balanced advantage funds were the right funds to get into. Of course, we weren't at all-time high levels. But of late, the theme in the market seems to be small caps and mid caps. Should a retail investor look at owning any of those?
See, I think if you have to buy small cap and mid cap, you have to understand what triggers their movement. They have longer periods of lull, and then they have sharp moves up, and again a long period of lull. So to answer your pointed question, Karthik, I think they can definitely look at mid caps and small caps. Small caps lesser so, but mid caps more so, because the domestic inflows are going to be reasonably robust in India, because the savings rate are expected to go up in certain strata of the society who are mutual fund investors. So point one, mid caps definitely going to be in flavor over the next 1 year in terms of relative performance to the large cap indices. A small cap, you should be a little wary because it's a very large universe. All stocks, there are about 3,000-4,000 stocks which can be there in small cap portfolios. So I think mid cap is definitely something which you should have your weightage at least 40% of your total equity holding.
Right, but having small cap funds, despite being a little more volatile, given better returns to investors who stayed invested for a period of 5 years or beyond. So I understand the volatility part, but from a return perspective, for somebody who's looking at a slightly longer horizon, should small caps still be avoided?
See, if you're looking at long-term periods, we saw the dispersion in returns between mid-caps and small caps. As the conventional thought process goes, longer periods, small cap will outperform. That is not proved to be true mathematically. Mid-caps have definitely outperformed. If you look at 5-year periods from large cap, there's a difference of about 3% when it comes to mid-cap. But from mid-cap to small cap, which is the next leg of a risk step which you take, you've not got the commensurate return. Small cap performances of the top 5 AUM funds has not superseded the mid cap top 5 in AUM, which is a surprising bit more contrary to the conventional belief. And so I also changed my belief that small caps, there is a probability of some small caps fading away, and the loss which occurs because of some of those stocks falling sharply undoes the returns of the top performers.
Right. So you mentioned retail investors should largely look at the large caps and the mid caps in a ratio of about 60-40. So if I can ask you directly, which are the top funds that you would suggest to somebody who's possibly, let's say hypothetically, got 1 lakh rupees to invest today? What should be the allocation across how many funds?
See, if you look at allocation wise, first let me tell you the funds, and then allocations are depending on the asset allocation. If you have 1 lakh rupee for equity
Right.
standalone, then you should probably look at 8 schemes. I'll mention those schemes. These are schemes chosen on different parameters, not just past performance. They're
Right.
chosen on a concept which we strongly believe, which is called the target NAV concept, where we find out the target of each fund's price of each of the
Right.
constituents. So if I mention those to you, HDFC FlexiCap, Franklin India Blue Chip, Mirai Asset Large Cap, Kotak Emerging Equities, Kotak Equity Opportunities, Canara Robeco Blue Chip, Canara Robeco FlexiCap. These are a few funds which you can definitely look at. DSP Mid Cap, like we were saying, is a mid cap scheme. So these, in the proportions mentioned on the screen, 10% to 8%, will give you a very strong, robust portfolio of 10 funds. Canara Robeco Emerging Equities, I forgot to mention. So these are the 10 funds which will help you get a portfolio which is reasonably diversified, not too diversified, not too concentrated, about 200 plus stocks in your portfolio automatically with these 10 funds.
Right. So are these funds going to be able to outperform the Nifty, outperform the benchmark indices, and in how much time? I mean, that 1 lakh should be invested immediately, should be an SIP, and how long should an investor stay invested in this portfolio given the current market circumstances?
I think there are two parts to your question. What's the kind of alpha you can assume? Alpha is the technical word for the
Right.
extra return you get over a benchmark. I think if you look at Nifty as a good, robust benchmark, because that's your opportunity cost, I think 2 to 3% a year after cost of regular schemes should be possible in these. Second part is how long do you not have to bother to monitor them? We have a very rigorous process because we are responsible for 6,000 HNI families. Individual investor doesn't have to do that, of course. We look at it on a weekly basis. So every 1 year, please be sure that you might have one scheme to change. So by which you mean in 10 years, you will have a full portfolio change.
Right.
So which is that particular one scheme deserves a change will require a very, very microscopic lens. Now, for example, we did this portfolio on 1st of January for this year. There is about a 5.38% alpha as of yesterday on these 10 schemes, if you bought on the same proportion on Nifty over the last 5 months, close to 5 months. But that's a windfall gain, but a 2% to 3% alpha over a year period is a fair expectation.
Right. And even a 5 to 6% alpha at a time when Nifty itself is at an all-time high definitely speaks volumes, Feroze. So good luck there and great fortune there for the 6,000 plus families that you're catering to. But does this allocation remain the same for somebody with a higher corpus? So in case somebody had, let's say, a 10 lakh rupee or higher amount of investable money that and allocated towards equity specifically, does this bucket and this diversification hold true even for somebody with a higher investable corpus?
Yes, with a higher investable corpus, there's no limit. By which I mean, even to a 100 crore equity guy, the same 10 funds would have been recommended. The problem becomes when you have only 50,000 to invest. Would you want to invest smaller components into 10 funds? If you can take care of the logistical nightmare which comes along for a small amount, it's still good to have the same 10 fund basket. People can modify and customize their risk on the basis of their asset allocation. The scheme selection does not require me to have different schemes and Kartik to have different schemes. Kartik might have 10% of his money. I might have 80% of my money in the same 10 schemes. So asset allocation helps you calibrate the risk, not the underlying schemes.
Right. Since you're mentioning about rebalancing these funds every couple of years, it's taking me to this emerging concept of small cases where rebalancing is done far more often. And of course, it's a diversified bucket of stocks and not a diversified bucket of mutual funds in that sense. Do you think small cases are gaining the sort of popularity to make mutual funds, think twice about their existence, or is it still early days?
See, I think evaluating your own skill in a bull market is not the right thing to do. That's my advice to the newer entrants. It's encouraging to see them actually get interested in equity. What fear comes along is if they burn their fingers sometime down the line, 1 year, 2 years later, then they shy away from equity for good. So point one, bull markets are not just a good period to evaluate somebody's skill. Second point is, I think mutual funds will have their relevance for good because they provide not just the good management, but also the time it saves you from doing this. So I think if you look at how mutual funds are going to gain in traction, I think we are still in very, very nascent stages. You have 6, 7, 8 times more money in fixed deposits than in mutual funds on the equity side. I think as interest rates fall and the investors feel the pinch of the fallen interest rate, and especially on a post-tax basis, they will want to save in a better platform which can do better than fixed deposits. So the target is not a direct equity client coming into a mutual fund. It is those guys who are enjoying 4-5% return and they're still lethargic to do something about their money. Those are the guys who would move here.
Right. And you'd also mentioned previously about the compounding effect of dividends. So dividends you receive on mutual funds are plowed back into the scheme and they sort of compound as well. Is that the case with the small cases as well?
So I think, yes, compounding, which is very, very important. You cannot have a leaking bucket anytime. Small cases, I think definitely dividend in these cases, small savings especially, they don't compound. So I think compounding is best in equity instruments. See, when you get a dividend or an interest and you put it back at 5%, the compounding is going to be very different than whatever you get from a mutual fund. And then you plow it back at 13%, the compounding itself is 4 times more powerful. So I think that's more in a mutual fund because the returns expectations are 12-13%. So compounding in a vehicle which has a 12% expectation is 5 times more powerful than an instrument which is a 5, 6, 7% or 8% return.
Right. And of course, I mean, the burning topic right now is cryptocurrencies. So, anybody we are speaking to, that is one question that comes up every time. So I can't let you go before taking your view on cryptocurrencies right now. Of course, as we understand, it's not a currency. It's becoming an asset class across the world with not too much underlying physical sort of, attribution. So is that something you are advising at all to your clients, or are you telling them to just keep a safe distance?
No, we asking them to keep a distance, very well knowing that you might miss out something. If
Right.
you say it will not rise up again or it will fall, no one knows. Because it's only demand and supply which is creating a price for it. So you never know if the world, most people, most HNIs want to have 1 Bitcoin, then the price could even be 5 lakhs. If none of them wanted, it could be as little as 4,000 or 3,000, like it had gone in 2018 from 20,000 or 18,000. So point is, we don't advise on cryptocurrencies at this stage. Second, not that it's an opinion on its price, because that's not something which you can discover very easily. Third, I think regulatory challenges are going to be there. Fourth, there will be several other alternatives which will come. People are forgetting the fact that Bitcoins might be limited, but there are so many different cryptocurrencies which are coming up. I just read that UAE has the first one. So what happens is then everybody will distribute themselves across different cryptocurrencies and not try and concentrate themselves across the popular ones. So that will create some degree of price pressure. And lastly, like you said, the currency has to be a currency, and it can never be a currency unless the volatility over the next couple of decades subsides to 1% a day from 10% a day.
Right, point taken there, Feroze. And last but not the least, the government has again opened 6 tranches of the sovereign gold bond, and we've seen gold levels also come down from their all-time high in August last year from 56,000 levels. They slipped down to 44, 45,000, and are back in the green now around 50. Where do you see the future of gold going? And do you still maintain that 10% of your portfolio should be allocated towards gold? If so, then in which format?
Yes, so if you want to have gold, it's very important that it has given some good past returns over the last 1-2 years. But if you look at long periods of time, it has not given great returns. If you look at it on a compounded 3-year basis over the last 20 years, 25 years, the answer is it has barely beaten debt for the risk it takes. So what happens is, I think gold reserves of all these currency top 10 countries is now at its all-time high. Now they're not adding more gold reserves. So that's where the demand comes from, and that's what dictates the global price. If you look at the gold price in dollar terms, close to 2000, about 10 years back, it was 1400, or at least in 2013-12, it had gone to 1300. So if you look at it, gold price in dollar terms, it has not given you stupendous returns. It's the rupee depreciation for the last few years and few decades has resulted in gold prices and rupee getting here. But I think when we come to Indian allocation, Indians have a large allocation towards gold in different forms. Should that be converted into sovereign gold bond? Without a second thought, because it gives you close to 4-5% extra return post-tax because of the return on interest, or interest which you get on a half-yearly basis, 2.5%. And it also gives you capital gain tax exemption if held till maturity. So no other instrument now in the country after this budget, where ULIP also were clamped down upon, only sovereign gold bond gives you a zero capital gain tax if held till maturity. So looking at these two gains, you might get 4% more or 5% more post-tax than the gold bar which you own. So convert that, per annum 4-5% is not a small amount. It can compound to very huge values over 10-year periods.
Right. And in the fixed income category, Feroze, is there anything at all worth considering right now? Because fixed deposits are not giving returns commensurate even with inflation once looked at it post-tax. So in the fixed income bucket, what does one do for somebody who's totally risk averse? My father, for example, where should he park his life savings today?
See, I think debt in the mutual fund category is a very low risk category. Okay, of course, the headline numbers of some defaults which would have happened in the last couple of years, not for the last 1 year, but before that, from 2018, when ILFS went bankrupt, or at least didn't pay up and was defaulted, there were a series of AAA companies which went down under. So having said which, to my mind, I think debt on the mutual fund side is a very safe proposition. Today also, you can buy 5 debt funds and make 6%, maybe 5.5% post-tax if could be held for 3 years. So to name a few funds, I think which is important, you can, if you bought these 4 or 5 funds, expecting a 5.5% post-tax return over the next year periods is not unfair. ICICI All Seasons Bond Fund, IDFC Dynamic Bond Fund, SBI Medium Term, Kotak Short Term Fund. I think these are the 4, and I think these 3-4 funds can definitely get you 5.5% post-tax because you get indexation. We are in a high inflationary, low interest rate environment relative to what we were. So you might almost get away paying 3-4-5% tax as against 35% tax possible on the FDs.
Right. So a wealth of information there for wealth generation for all investors out there. Feroze Azeez, thank you so much for joining us on this Money Masterclass. Always a pleasure having you with us. Thank you so much. Well, that's a wrap on this show. This was Feroze Azeez, and thank you for staying tuned with us on Money9. Do log on to our website, money9.com, for more news and updates. Goodbye, and thanks for watching.